Good morning, Multibagger hunters. Welcome back to the Daily Hunt for Multibaggers on this Thursday, April 23rd, 2026. Brooke, it feels like the market has thrown everything at us today.
You're not wrong, Ethan. Our AI-generated insights for data collected yesterday, April 22nd, certainly show a lot of chatter. We saw a significant volume of posts flagging many different stocks, creating a really mixed bag of sentiment out there. Some truly promising prospects, but also quite a few high-risk situations for investors to navigate.
All right, let's dive right into it, starting with Poet Technologies, Poet. Brooke, this one is buzzing. We've seen a massive surge in discussion, with users celebrating gains and believing this company might be a real company. Orders from Marvell and links to NVIDIA are fueling an AI rally, with the stock rocketing from under $4 to almost $13. People are calling for $40 to $80 by year-end, driven by their superior photonics tech for data centers. It sounds like a significant turnaround story.
Ethan, while the enthusiasm for Poet is undeniable and it's great to see that kind of community optimism, the current financial KPIs are still quite concerning. The company is currently unprofitable with a net profit margin of 0 and negative earnings per share. That high debt-to-equity ratio of 3.845, coupled with a price-to-book of over 9, means investors are paying a huge premium for future potential, not present earnings. Yes, the Marvell orders and AI links could drastically improve these numbers, but they haven't yet. We flagged Poet as a stay away yesterday, and those fundamental risks are very much still present.
I hear you on the risk, Brooke. It's definitely speculative.
Exactly. So for Poet, our verdict today is stay away. It's just too speculative with the current financials.
All right, next up, IBM. This one's interesting. They actually beat Q1 earnings and revenue estimates, and their AI segment is reportedly booming sales. What really caught my eye is that insiders have been aggressively buying, increasing their holdings by almost 29% in the last 6 months. That's a huge vote of confidence, signaling that those closest to the company see long-term value despite some market skepticism.
Ethan, an earnings beat that results in the stock sliding is a stark signal of underlying market apprehension. The debt-to-equity ratio for IBM is astronomical, nearly 200, which is a major red flag for financial leverage. While the 12.2% revenue growth is positive, it's not the explosive growth that would typically offset such a high debt burden or overcome the market's focus on a consulting soft spot. Insider buying is a good data point, but it's not enough to justify the current risk profile for most investors. We previously rated IBM as a stay away in February, and despite the Q1 beat, the market's reaction suggests those concerns linger.
Fair points, Brooke. It seems the market is prioritizing those risks right now.
For IBM, we're sticking with stay away.
Moving on to Avis Budget Group, CAR. This stock has generated an enormous amount of discussion, mostly negative, with users predicting it will end badly and comparing it to Hertz. But Brooke, here's a fascinating counterpoint. Insiders have been aggressively buying shares, increasing their holdings by over 700% in the last 6 months. This suggests a strong belief in future appreciation from those with the most information. Plus, the news confirmed this Avis short squeeze is real, hinting at massive potential price swings.
Ethan, the insider buying is a powerful signal, I grant you, but we absolutely cannot ignore the catastrophic fundamentals. CAR has a negative price-to-book ratio, meaning their liabilities exceed their assets. It's fundamentally unprofitable with negative revenue growth and massive negative earnings per share. This isn't just a shitco, as some users call it. It's a business in severe financial distress. A beta of nearly 2.0 confirms extreme volatility. While short squeezes can't offer speculative gains, the underlying business is too weak to be considered a sound investment. We've never rated CAR before, but these numbers are screaming caution. It's a high-stakes battle between fundamentals and insider conviction, that's for sure. Indeed, for CAR, our verdict is a definitive stay away. The fundamental risks are too great. All right, let's talk Lululemon Athletica, Lulu. The market reacted harshly to the news of an ex-Nike executive being CEO, with the stock dropping. But I think it's an overreaction. Lulu still boasts a healthy net profit margin and low debt, which speaks to its underlying financial stability. The current PE ratio is relatively low, which could signal undervaluation for a brand that, while facing some headwinds, still has loyal customers. Plus, we've seen some net insider buying. This could be an opportune dip for a profitable company. Ethan, while Lulu's current profitability is fine, a 5% drop on CEO news and a stock price less than half its 52-week high is a clear indicator of market concern. Their revenue growth is anemic at just 0.8%. That's nearly stagnant for a company that was once a growth darling. The PE of 12.32, while seemingly low, reflects lowered expectations if growth can't be reignited. Users are concerned the company will mirror Nike's struggles, and until a new strategy to drive significant revenue growth becomes clear, the risk outweighs the reward. We had it as a buy in December, then stay away in January, and it feels like we're back to that cautious stance. So waiting for more clarity on their strategy. Precisely. For Lulu, our verdict is stay away. Next, Micron Technology. This stock is on fire. We're seeing gain porn from users, with some targeting $600 to $700. The AI memory boom is driving insane demand, confirmed by SK Hynix's stellar earnings. Micron's PE ratio is an incredibly low 0.26, suggesting it's undervalued despite being near its 52-week high after a monumental run. Their operating margins are phenomenal at nearly 68%. This looks like a prime beneficiary of the AI revolution. We've rated it buy many times in the past. Ethan, the AI tailwinds are certainly strong, and those operating margins are impressive. However, we have to look at the other side of the coin. Micron is trading very close to its 52-week high after an astronomical surge from 73 to nearly 490 in a year. The debt-to-equity ratio is extremely high at almost 15, which presents a significant financial risk if market conditions shift. And importantly, insiders have been net sellers, liquidating over 13% of their holdings in the last 6 months. While the long-term outlook tied to AI is promising, buying at these highs with high debt and insider selling requires extreme caution. We actually rated it stay away just yesterday. A valid point on the insider activity. It's a tricky one. Given the extreme highs and the financial leverage for Micron, our verdict is a cautious buy. All right, let's tackle Tesla. It's been generating the most hot leads today. Users are overwhelmingly bearish, with many predicting it will be down huge and calling it a hype company with no fundamentals. But Brooke, the company actually beat Q1 earnings and revenue estimates. They're making a massive strategic pivot into AI robots and robotaxis, with FSD subscriptions soaring. This is a company innovating at the bleeding edge, and their future potential in AI could dramatically turn around their financials. Ethan, that future potential is already priced in at an astronomical price-to-earnings ratio of over 355. That's extreme overvaluation. Compounding that, their revenue growth is negative at negative 3.1%, meaning the core business is shrinking. The debt-to-equity ratio is very high at almost 18, signaling significant financial risk. Users are correct. These aren't the fundamentals to support such a valuation. An earnings beat that results in further bearish sentiment means the market is no longer buying the hype. We've consistently rated Tesla as stay away for months, and today's data doesn't change that.
The market certainly has its doubts.
Absolutely. For Tesla, our verdict is stay away.
Moving to Microsoft, MSFT. This one is a consistent performer. We saw users reporting gain porn from their options with a target of $500, and MSFT was a key contributor. The company shows strong fundamentals, 16.7% revenue growth, excellent net profit margins, and incredible return on equity. They're a top AI play, with Azure driving growth, and the current price is well below its 52-week high, leaving plenty of room for appreciation. We rated it buy yesterday, and nothing seems to have changed fundamentally.
Ethan, Microsoft's profitability and growth are indeed impressive, and they are strategically well-positioned in AI. However, we can't ignore the regulatory risks. They're facing cloud licensing lawsuits, and there's chatter about a code red in the competitive AI race. While not a stay away, and the insider selling is minor, these are factors that could pressure future growth rates or margins. My only hesitation is the increased scrutiny, but the core business remains robust. I think the positive outweighs the potential headwinds here. All right, for Microsoft MSFT, our verdict is buy.
Next up, NVIDIA, NVDA. This stock has been an incredible growth story. Their revenue growth is astounding at over 73%, with excellent net profit margins. They're expanding into quantum computing and AI robotics, cementing their leadership position, and insiders are showing massive confidence with significant net purchases. While some are worried about the top, its PEG ratio is still attractive, indicating strong growth relative to its PE. We rated it buy just 2 days ago.
Ethan, the top is exactly what the social media users are worried about, calling it not a safe bet and predicting wild swings, especially for leverage positions. The stock has nearly doubled in a year and is trading almost at its 52-week high. The beta of 2.335 confirms that extreme volatility. A PE of over 41 means a lot of future growth is already priced in. While the fundamentals are robust, for a new investor, especially with leverage, entering at these near-peak levels with such high volatility makes it incredibly risky. Google's new AI chips also signal increasing competition.
The risk profile is certainly elevated at these levels.
Indeed. For NVIDIA, our verdict today is stay away.
All right, let's talk Alphabet, GOOG. This is a clear buy in my book. They're showing 18% revenue growth and fantastic profit margins. Google Cloud is expanding rapidly with major partnerships like SAP and Accenture. And their aggressive investments in AI, including new chips and a $750 million AI fund, position them for incredible future growth. Plus, insiders are buying heavily, showing strong conviction. This company is a fundamental powerhouse. We rated it buy yesterday.
Ethan, the fundamentals for Alphabet are indeed undeniably strong, with excellent profitability and growth metrics across the board. The significant insider buying further reinforces that internal confidence. My only minor point of caution is that the current price is very near its 52-week high, and the PE of 31.24 does bake in a lot of future expectations. But strictly based on the numbers and news, it's a very solid picture. It's tough to find a real fault here. For Alphabet GOOG, our verdict is a solid buy.
Finally, Reddit, RGDA. This platform is showing insane revenue growth, especially in advertising, at nearly 70%. Analysts have high price targets, some up to $320, and the company has a $1 billion share repurchase plan. Our aggregated data even shows strong net insider buying, despite some concerns about specific insider selling. They're monetizing their massive user base, making it a powerful growth story. We rated it cautious buy 2 days ago.
Ethan, while that revenue growth is certainly impressive, Reddit's price-to-earnings ratio is an incredibly high 62.95. That means a huge amount of future growth is already priced in, making it highly susceptible to disappointment. The beta of 2.407 means the stock is extremely volatile and could see significant drops on any earnings miss, as some users predict. And we can't ignore the specific user concern about a high-ranking executive continually selling shares. It's a high-stakes gamble relying on flawless execution to justify that valuation.
So a lot riding on those upcoming earnings.
Absolutely. For Reddit RDDA, our verdict is a cautious buy.
All right, that wraps up a very active day, Brooke. Let's quickly recap our candidates for deeper analysis. Investigate as buy, Microsoft Corporation, MSFT, Alphabet Inc., GOOG. Investigate as cautious buy, Micron Technology Inc., MU, Reddit Inc., RDDA. Investigate as speculative gamble, Poet Technologies Inc., POT.
And that's our take for today. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us on the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated insights into the market's most discussed stocks. Happy hunting!